I'm very happy to understand that there are a lot of people physically present in the auditorium where you've had the first half of the conference today. So welcome to all of you, and welcome, of course, to all who are watching online. The title of this panel is very modest. It's how to prepare the EU to confront the challenges ahead. As we know, these challenges are enormous. In the chatting before we came on, we were all saying this was maybe sort of the worst crises or the worst state the world has faced in our lifetimes, which says something about how perhaps we've had a reasonably lucky lifetime, considering. But we want to look into the future and what to do in the immediate and more distant future. So I'm joined by four excellent panelists. I will just very briefly say who you are in the order in which you will give your introductory speeches. José Manuel Campa is the president of the European Banking Authority. Vítor Constancio, former vice president of the ECB and now chair of the School Council at the Lisbon School of Economic and Management. Lucrezia Reiklin is a professor at London Business School, and Pierre-Olivier Couranchas, of course, is the chief economist of the International Monetary Fund. Welcome to all of you. It's really wonderful to have you. We're just going to give the floor to each of you in that order for you to give your introductory speeches on each of you on a topic around this general challenges facing the EU. And we'll then move, like in the previous session, to some question sent by previous winners of the Bernàcer Prize. I should say that all the panelists are either themselves former winners of the prize or they have been on the selection committee for the prize several years running. That's all from me. Again, thanks everyone for being here in person or virtually. José Manuel, I'll hand it to you first.
Thank you, Martin, and good afternoon or good morning to all of you, wherever you happen to be. It's a pleasure to be here, and I want to thank Immaculada, particularly and the organizers, for putting on this event together. It's wonderful to see many good friends and old friends. So in my initial remark, I will focus mainly on the status of the banks in Europe, I'll start by addressing how they were at the beginning of the year, coming out of the COVID pandemic, if I may, recall people, because we tend to forget that was also a very exceptional period. Then I'll discuss a little bit how we see the first and second round effects from the Russian war on the Ukraine on the banking sector overall, and what are the challenges there, and then I'll finish up with a little bit more of what we see as the medium and long-term challenges given the macroeconomic outlook or the wider macroeconomic uncertainty. So first, on how the banks looked at the beginning of the year, I must say that they were actually quite good in terms of capital and liquidity, the two basic ratios that I can summarize more or less the activity. In terms of capital, the ratio of the average of the region was 15.4 core equity tier 1 ratio. That was a ratio that surprisingly to many of us over the last 2 years actually continued to increase despite the COVID-19 crisis, thanks of course to the many exceptional economic, fiscal and monetary policies that were put in place to address that crisis. At the same time, liquidity was also ample, with ratios of liquidity of about 175% on the liquidity coverage ratio. The NPL ratio of the industry actually dropped throughout the COVID crisis of the last 2 years, and it was a 2% NPL ratio at the end of the year. It is true, though, that, and this is important, that at this time the decline that we observed in the NPL ratios was different by sector. And NPL ratios overall declined, but we see that some of the sectors most affected by the pandemic had already started to increase their NPL ratios in the previous quarters. I'm thinking about, the transportation industry, the tourism industry in particular, all those. Also, we were beginning to see early signs of credit quality deterioration, particularly, those loans in the bank's balance sheets that were under moratoria or had been under moratoria that had expired already. Those portfolios had worse quality in terms of they had higher NPL ratios. They also had higher stage 2. The same thing happened to the loans that were under public guarantee schemes, had been on the public guarantee schemes. It's worth noting that by the end of the year, although the loans under moratoria had almost disappeared across the European Union, there was a very small percentage left. In the loans under public guarantee scheme, there were still over 300 billion euros of loans in that situation. So that was the status of the industry. Now, at the beginning of the year, we were forecasting that as we were coming out of the pandemic and the exceptional monetary and fiscal policies that have been put in place that I mentioned before were going to be removed, that we should see an increase in the deterioration of asset quality. So NPLs should continue to rise, or will continue to rise overall, and should continue to rise in those industries most affected. And that was a challenge for the banks, but we sort of perceived, and this was the outcome of our stress test from June of last year, that overall the banks will be able to manage this properly. Now, of course, the Russian war started on the Ukraine, and that changed the scenario substantially, on top of already some disruptions that we were seeing in terms of like supply chains and inflation that I referred to later. Now, the impact on the banks in terms of the immediate impact of the Russian invasion, it's relatively small. What we call the first round of the direct exposures of European banks to the Ukraine and to Russia was limited, 19 billion euros. There was some disruption in terms of resolution on some institutions within the EU that were either heavily linked to shareholders in Russia or heavily affected by the sanctions being imposed by the European Union, but that was also managed without any significant impact on financial stability. As we go forward, we continue to think that those first round effects will remain limited. We have seen over the last month a number of European banks, following also many other corporates, either completely exiting the Russian market or severely limiting their activities there and divesting from there. Now, of course, the concern is about the second round effects. It's a much bigger concern for EU banks. Here we see that there will be clearly an increase in credit risk, derived by the decline in overall macroeconomic activity, but also by some expected default for some of the entities very more affected by sanctions, also some of the entities more affected by the crisis, depending on the sectors in which they operate. We've seen also increase in market risks, because there's been an increased volatility, obviously, in many markets, particularly the only derivative and energy markets. And also we have also obviously seen increases in yields of sovereign exposures in general, but not only, also corporate exposures. Now, liquidity, I think, remains comfortable for most banks. Of course, funding risk may increase a little bit, but more than funding risk, I would say funding costs may increase. Now, as we think about what the banks are confronted by as a result of the crisis in the short term, I would highlight two specific risks. One is cyber risks. From the beginning of the crisis, we were heavily concerned about the likelihood that the cyber risks may increase and cybercrime may increase. We have not seen so far a significant increase in that area, but nevertheless, I think that a warning on that direction and keep making sure that operational resilience high is a priority. Second one is a risk on effectively implementing the sanctions from the financial sector. We've learned from the past that there can be large penalties from banks not effectively implementing sanctions. So far, we've been monitoring closely what banks are performing. I think banks are trying to be as effective as possible in the implementation of those sanctions. I think they have the attitude to make sure that they implement thoroughly and convincingly, but it's important that they continue to do so. Fortunately, many of these sanctions have been heavily coordinated at the G7 level, so there's I would not say a unanimous view of what the range of sanctions are and the implementation challenges, but it's a very high level of coordination that will help going forward, that will help the banks going forward. Now, as we go forward, and thinking more about the macro uncertainty, I think it's very clearly, and I think that would be considered by everybody, that the macro look has heavily deteriorated. But having said it has heavily deteriorated is only talking about the mean. For me, the most very important is that the macro uncertainty seems to also to be much higher than it was before. And how are we going to weather that uncertainty going forward, both in the short term and in the medium and long term, is probably the biggest challenge for all of us, and of course, as a result of that, for banks as well. And that macro uncertainty, I would like to highlight three aspects which are heavily important for the banks. First of all, of course, as I mentioned before, is the market risk and the potential increase in yields, so also the reappreciation of some of the asset classes that we've been seeing over the last 2 or 3 months that may impact the credit quality of counterparty of banks. The second challenge is the challenge of the evolution of some of the sectoral composition of GDP growth. And we know that some of the sectors are going to be more affected by the crisis than others, and exposure to those sectors, it's again an area of focus for banks. And the third part that I mentioned before is the cyber-related risk and the information-related risk. This is an area in which we have not seen yet significant disruptions, but we should not disregard as potential risks. Now, the banks, of course, are confronting this, as I said at the beginning, with a good starting levels of capital and liquidity. That's really good. I think that that's been very helpful, but at the same time with an ongoing challenge on profitability and transformation of their business models. The bank's return on equity over the last decade has been low. For most years, actually, has been below the cost of equity. That's been a challenge for banks. And at the same time, the technological transformation and the structural transformation in the industry continues to be there, and banks need to make an effort to make sure that they can keep up with the transformation and effectively address the challenges that transformation brings, both in terms of digital transformation, but also on leading with legacy assets. So let me stop here for my initial remarks, and I'll be happy to continue later on in the debate with the discussion. Thank you again for the invitation.
Thank you so much, José Manuel. Since you've been so admirably within your time, I just want to ask you one quick follow-up. There were some subsidiaries of Russian banks that had to be wound down in late February, early March. And I'm just curious if you think that that was a solid test of the bank resolution regime that we've sort of set up in Europe over the last 10 years, or whether it was such a special case that it doesn't really tell us much about how solid that system is. If it was a test, I suppose we passed the test.
I was going to say, it certainly was a test, I would say, because at the end there was an effective resolution of, as you say, of two institutions in different ways, both institutions. I think that in the first case, there was a resolution that took place over the weekend right after the first invasion of the Ukraine, very fast, and it was a complex case in which it was a group operating in the Union with subsidiaries operations in a number of countries within the Union, both banking union members and non-banking union members. And I think that the Single Resolution Board with the National Resolution Authorities managed to resolve that effectively without any really significant impact on financial stability. So I would say that that was, in that sense, a positive test. That doesn't mean that there are no lessons to be extracted and that we should extract lessons going forward as well. But overall, I think that the lesson or the conclusion is that it has been a positive experience.
Always said restructure early, restructure often. We go from banking and financial stability to the macro challenges. Vitor, over to you.
Thank you, Martin, and thank you to the organizers for putting up this event after many years of presiding the jury as a vice president of the ECB, because there was that tradition in the formation of the jury of the Bernàcer Prize. It's, of course, with great pleasure that I participate in this event. So, looking to the macroeconomics and the challenges that the new situation creates, I will very briefly mention first what are those economic developments that present those challenges. We all know about them, of course. But the more recent concern has been about the possible significant deceleration of growth, or even a recession, because in financial markets, particularly in American ones, everyone assumes that there will be a recession in Europe as a result of the present situation, and there will be certainly at least a big deceleration of growth. Despite the latest IMF forecast, which is the more recent one, of a growth rate of 2.8% this year in the euro area, we have to consider that there is a very big carryover from last year as a result of the growing path of growth during 21. And to the amount of 1.9, the value of that carryover. So it means that the real growth during the year is indeed lower than the 2.8 and will be declining over the different quarters of this year, meaning that by the last quarter, growth can be very meager and perhaps in some countries even negative. We don't know. But it is not yet certain that there will be a recession, but certainly much weaker growth. And that's for all the reasons that, of course, we know. The inflation itself being in energy and food, and then lowers real income for other purchases. The war uncertainty increase the tendency for households to save more, and we can expect that affecting consumption. Investment in housing will decelerate as a result of the drop in real income and mortgage rates going up, although they are still on the low side. And business investment, of course, will be affected by the so-called animal spirits. And we see all the soft indicators in Central Europe going down very, very significantly. On top of this, we have to confront that the present trends of both fiscal and monetary policy are towards the restrictive side. And so that's what we have, I think, to discuss. Inflation will abate in the second half. It's everyone's expectation. The second round effects in the euro area exist in terms of the repercussion of the import prices on the production of others, but wages are not yet really responding in a visible way. And if we take the ECB wage tracker, they foresee a peak of wage increases in nominal terms of 3% this year and around 2% next year. And that's nominal, which means that if we take into account then inflation and some growth in productivity, unit labor costs will slightly decrease this year and next, so they will not put pressure on inflation. And that's why all known forecasts point that throughout 2023, inflation will abate towards the 2% by the end of that year. So what fiscal policy should do? Well, as planned and as it was begun to be implemented, fiscal policy will be restrictive this year. As planned, budget deficits, both the overall and the cyclically adjusted primary balance, will be reduced compared with previous years. And that's then, of course, a slightly restrictive fiscal impulse. And at least, that's my first point, fiscal policy should accommodate in the deficit, meaning allowing it to increase a bit, the direct fiscal costs coming from the war. And these are, of course, household relief in terms of energy and food, whatever the instruments that will be used for that. And that's the first component that already many countries are, by the way, implementing in different degrees. Then there is the cost with the refugees, which also will be meaningful in terms of the millions that are involved. And then the increase in defense expenditures and the spending for the Ukraine reconstruction, which is now under consideration, of course. And on top of this, we have, of course, the need to step up greening investments, public investments, because we are in danger of not complying with the targets for 2030. The bulk of investment, as we know, will be to the private sector, but the private sector will not do those investments if there are not enough public support, because otherwise profitability would not be there to justify a pure commercial private investment. So, in face of all these, then the first need, the first big change we need in Europe is a real reform of the Stability Pact. If there was a reason to do it, and there were already several reasons, that would be the moment to do it. Let me remind everyone that the Stability Pact per se, contrary to the treaty, implies that the debt ratio to GDP should converge to zero in the very, very long term. Not to 60, but to zero. That's what in the Stability Pact. And the additional rules of the Six-Pack and the Fiscal Compact need also to be changed, in particular in what regards the convergence formula to 60% by reducing the debt ratio by 5% each year, of the excess over 60 that a country may have. And that would be the minimum thing, this change of this formula of convergence. But more than that is necessary. Last year, I was invited to address the informal ECOFIN on the reform of the Stability Pact, and I tried to justify that the target for the debt ratio should be 90 and not 60, using exactly the same economic rationale that was used at the moment of the Maastricht Treaty, and that, of course, introducing an expenditure rule would imply that the deficit, it's not a target, it's an outcome in such a fiscal rule. I became nevertheless very pessimistic about any meaningful reform being done after reading the Spanish-Dutch non-paper agreement that doesn't mention at all even the elimination of the convergence rule, of the reduction of 5% of the excess every year, and as a very vague reference to investment protection. So that was a big disappointment to me and bodes ill for the future. So I am not ignoring debt sustainability concerns, of course, because they should be there. They are there also in an expenditure rule. But we are asked to consider that in the immediate future, sovereign yields have increased, yes, but with inflation, both the debt ratio and the debt dynamics that is given by the difference between interest rates and growth rates, either in real or nominal terms, both imply a significant reduction of the debt ratio this year and next, and that's in all forecasts, by the way. And then if the future inflation abates, that will also be translated into the evolution of sovereign yields. So indeed, the nature of some of the expenditures I mentioned, particularly household relief and the refugees, are temporary. They will not be permanently there. So I think that the accommodation in the short run that I mentioned is warranted. And of course, everyone now expects that, according to the Commission proposal, the Ukraine reconstruction costs will be included in a type of next generation package that then impacts the national deficits much later on. Monetary policy is a balancing act in such a situation, but I think it will not really disturb too much the balanced evolution of the situation, because monetary policy cannot ignore that the economy is already cooling off, and that will help inflation control later on, that wage performance is not putting pressure on unit labor costs, and at the same time that the markets are already doing a lot of the work of central banks by pushing up all financial conditions, and in particular, of course, sovereign yields that are at the level that they were in October 2018 already. But they can still go a little bit higher than that. It's not to be excluded, but when inflation abates, that will be then also correct. And now we see that the moment in the markets is such that the concerns with growth have increased so much more recently, that sovereign yields, both in the US and in Europe, have decreased a little bit in the past 2 weeks as a result of these growing growth concerns that is already present in the markets. And if we look to the futures markets about interest rates, policy interest rates, both in Europe and in the US, we see that, yes, in Europe, the ICE market futures points to 1.5 MRO by the end of 23, but then a stabilization until 27 around 1.8. And for the US, it's a stabilization in the longer term around 3%, going marginally above meanwhile, but then stabilizing slightly below to 3%. And that's the wisdom of the markets right now. And there are justifications for that. And in particular, the idea that the markets more and more are reflecting that very likely the Fed in particular will not have to implement all the increases in Fed rates as they were already priced in the markets some weeks ago. And I finish here.
Thank you so much. I can't resist trying to tease a little bit more out of the last things you said and ask what you would do if you were still on the ECB board, because I've noticed people comment on this morning's panel on Twitter and so on that there were views that the ECB has not done anywhere near enough.
Yeah.
There was, of course, Philip Lane's explanation that they've done exactly what they need to do, and I'm just curious. I mean, do you think that they're at risk of doing too much?
In Europe, no, I don't think so. I think that in the US, yes, there is that risk, but I think that they will refrain in the end from doing too much. That's also what the markets are now expecting. In Europe, I already tweeted that it's reasonable that the ECB will implement 2 or 3 hikes before the end of the year. So let's say by the end of the year, the MRO would be at 0.75, and that perhaps a few others will happen in 23, but they will have to be considering all the points that I mentioned, and I'm sure they will, and in particular that before these set of increases of 25 basis points, 3 or 4 until the beginning of 23, they will have to be strictly data dependent from there, and really considering all the developments that meanwhile will happen on what will happen to inflation. If inflation, as anyone expects, will abate in the second half of this year and will end the year around 4, perhaps slightly below 4, then we are in a different situation, and the more restrictive financial conditions will continue to do their work in terms of cooling off the economy sufficiently to implement the conditions that will bring inflation to around 2% by the end of next year.
Thank you so much, Peter. I hand it over to Lucrezia.
Thank you, Martin, and it's a pleasure to be here. So I'm also going to talk about the macro context, and I will probably say things which are very, very similar to what Peter said. Usually we are on the same side of the debate on many things.
Yeah.
So my first point is that the war changes the macroeconomic very substantially, and also the geopolitical context worldwide. And I think that this will have a lasting effect, not only because the effect that it will have on how international trade will develop in the future, but also about energy policy and Balkanization in general. Now we are here to discuss about the EU, and I think, and this is my second point, that the EU will be particularly affected. I mean, this is maybe as a banality, but the reason why the EU will be particularly affected is because the EU is particularly dependent from Russia on oil and gas. So the European Union has facing several shocks, and some of them we have already commented on. That he will increase military expenditure. He will be confronted with the refugee crisis, and especially is facing a big shock on real income, which is due to the increase in energy and food prices. So in terms of quantifying these shocks, it is probably the case that the impact of the refugee crisis and the military expenditure will be limited. On the other hand, the effect on the increase in energy prices and other commodity on income is going to be large. I mean, a sizable macroeconomic effect, maybe, of the order 2% of GDP, but with also quite heterogeneous effect in different group of populations and different countries, which of course doesn't help the coherence of the political, of the economic response. Now, in the long run, facing the shocks, we know that the EU will have to rethink the energy policy, and this transition will be costly. Again, the cost will differ across countries and across groups of populations. In the short run, I agree with income. This is it's a substantial negative shock, a macroeconomic shock on income. It is, in the short run, this is compounded by the slowdown of China, which makes Germany particularly vulnerable at this juncture. And so the numbers for Germany are not pretty, the number on growth. Now, the forecast for 2022, Victor has already commented on that. They go from the 2.8% of the IMF to 2.5% of private banks and forecasters. But, there is, at least the market thinks that the possibility of recessions in Germany in the second part of the year is actually has increased quite a bit. Of course, there is a lot of uncertainty on these numbers because, there is a lot of uncertainty about the evolution of the war and the response to the wars and etc. Now, my third point, so this is about the macroeconomic shocks. So second point, the EU is facing a large macroeconomic shocks, possibly persistent and with implications also for the long run. My third point is that there is no doubt that the fiscal response to these shocks, to cope with these shocks, will be inevitable. So I agree with Victor that the fiscal is, of course, the direction of travel was for fiscal consolidation before the shocks, but that actually this direction of travel is not necessarily there anymore. Countries have already put in place several measures to deal with the consequences on real income on the energy shocks. And, the signals are already there that, there are measures that have been put in place that we can discuss about, to protect households and the companies most affected. Also, policies are needed to achieve the independence from imports of Russian fossil fuel. And then, there is a question on how to make this policy coherent, the policies to become more independent from Russia and the policies to kind of compensate the losers of the energy crisis. Now, of course, this policy will have costs for public finance. Public finances are already stretched, and this, of course, have implication for public debt. The discussion is well known for everybody around this table. Public debt for the union as a whole might not be a concern, but of course, when there are this kind of risk and these kind of tensions, the pressure on some of the sovereigns is going to be large. We have seen already the spikes on the spreads on the Italian sovereign debts that I think today is well above 200 basis points. This will be, a macro risk, but also financial stability risk. So this leads me to my fourth point, fiscal policy. So this fiscal response is inevitable. That was my third point. The fourth point is also that the monetary policy tightening, on the other hand, is going to be inevitable. First of all, because normalization was already underway before the crisis. Now with inflation, it is the monetary policy will, has already announced, a start of the tightening cycles, and this will hurt. So the question is how much this will hurt and how can we mitigate with a mix of policy, the effect on real income of the tightening. But the second question is really how effective will be monetary policy in this kind of facing this kind of shocks that we're facing today. So, and my fourth point is it is indeed that Europe will have to reflect about an ideal combination between monetary and fiscal policy to deal with this type of shocks. Let me give you some facts about inflation. So inflationary pressures were already visible in late 2021. They have obviously exacerbated. In April, inflation was already 7.5%. What kind of inflation is this? I mean, there is a debate out there. I think the consensus is that unlike in the US, this is in Europe is still a supply-driven inflation. The US inflation has been also pushed up not only by monetary policy being late, but also by a very aggressive fiscal response during COVID, which was much larger than what we have experienced in Europe. Energy, on average in the euro area account for more or less half of headline inflation, but in the United States, this is a smaller contribution. So I think this is important difference between the US and the EU. Until recently, expectations had been quite stable in the euro area, but actually lately they have started picking up. So this is a room of concern. So my view of inflation is quite nuanced. It is true that it's mostly supply, but actually, there is now some evidence that expectations are affected. So, it would be a mistake to be complacent, okay? However, I agree with Victor that, it's a very kind of gray area because there is not so much evidence of second round effect related to wages. There is some increase in profitability in some of the in profits in some of the sectors, but wage dynamic has been quite subdued. So how much the ECB can do, if we think, okay, in terms of contrasting the first round effect, there is not much that monetary policy can do to the extent that this is mostly supply driven, but of course, a central bank can act to limit second round effect. But to the extent that it does that, that will have a depressing effect on demand in a moment in which actually there are signs of slowdown. So I agree with Victor, is a balancing act. We'll have to be very careful, very much data-driven. I think the ECB so far, I'm quite supportive of what they have done so far. I think they've been quite careful. And I think actually the new flexible inflation targeting strategy that they put together seems to work. I hope I'm right. Now, one point of attention is, of course, that tightness has the fiscal consequences of increasing the sovereign spreads. Now, this is an important point for anybody who follows euro area development. Whenever there is risk, we have this tension in the sovereign market, which actually very much works against the direction of monetary policy. I have a recent piece in Vox in which we try to quantify, what happened when there is an interest rate change, on the MRO change at the euro area level. What is the effectiveness in the periphery if at the same time, there is flight to safety, which implies increasing spreads in the periphery. So this is, the problem is that it is very likely that we're going to be confronted with the problem of balkanization of financial markets. And this, of course, will worsen the trade-offs that the ECB is facing. So this leads me to my fifth and final point, that if to be prepared to this new situation, I think we will have to think very carefully about the calibration between monetary and fiscal policy. On monetary policy, given the fact that tightness, it is almost unavoidable, with the nuances that I've tried to describe, the ECB has to think of a PEP-like extra instrument to deal with the financial issues of the segmentation of financial markets due to sovereign spread, sovereign tension. The tightening will be more convincing as a policy, provided that is complemented with an instrument which is targeting financial stability concerns more than macro concerns. That's for monetary policy. And for fiscal policies, I think that in a way, to have fiscal policy can be more targeted. This compensation of the losers that I was describing very vaguely, very generally before, can ameliorate the trade-off between output and inflation, this will help. So the combination and of monetary and fiscal policy will help to face this trade-off. Now, of course, this will have to be financed at least partly by additional debt. So we need to consider, I think that Europe needs to consider a COVID type of response at the fiscal level, thinking about putting on the table again the issue of common fiscal capacity to deal with the energy crisis. Now, if I have a prediction about whether this is it is something likely today, I think this is unlikely. I think there is no, as far as I see, there is no appetite for putting this kind of reform on the table and talking again about common fiscal capacity. There is kind of a post-COVID fatigue I see in the EU. So far, it's been difficult to find consensus on anything. And if you have read the recent Repower EU, which just was announced last week, is really underwhelming about what has been put on the table. It is clear that there will not be a new facility for issuing new common debt, that it was done in 2020. This package is more about reorient, some of the resources which are already there, to face the energy crisis. So that means, if I have done a prediction that the fiscal policy response will be mostly a national effort, and therefore, I am quite worried that, this combination of national fiscal policies and together with the tightening of monetary policy is making the EU extremely fragile. And so I hope that at some point, reason will push our several people in charge and government and institutions to think of a more deep reform of the fiscal framework. And I think that more than the Stability and Growth Pact, frankly, which has now basically pushed up again, and I think the most important reform will be really to rethink about the common fiscal capacity. With that, I finish.
Thank you very much, Lucrezia. I think that I will classify that as the most pessimistic of the three presentations we've heard so far. A lot of warnings, a lot of reasons to think that monetary tightening and or fiscal tightening would lead to bad things, although you were cautious not to say that tightening shouldn't happen, if I understood you right. I just wanted to ask one thing I didn't quite understand, if you can clarify. When you say that a tightening overall monetary stance would be more convincing, was the word you used, if it was paired with some new instrument for avoiding basically widening spreads. Does that mean convincing in terms of effectiveness of the actual policy? Does it mean convincing in terms of credibility, politically? What did you mean?
Effectiveness. If you think what happened in PEP, during COVID, so the type of instruments that were put together, that had this double function, macro, of course, because there was a big recession, but mostly it was about avoiding segmentations. So that the first thing that happened with COVID is that spreads spiked up, both sovereign spreads and the spreads between secure and unsecure, different quality of credits and so on. And the liquidity policies that the ECB put together and the targeted policies on the sovereign market actually had the immediate effect of compressing those spreads. And so that was a key element of the response during COVID. And actually that, together with the NGU, provided a kind of fiscal monetary coordination that made that kind of response what we now consider a success overall, at least. And I don't think that we have something like that now. I mean, I know that the ECB is discussing of, having PEP-like instruments also to cope with this crisis. And in a way, whether we will need that, it really depends, first of all, on how fast they will tighten and how effective will be those fiscal measures that both at the national and the federal level are being discussed. Okay, so I mean, it's really the answer will have to be in the combination. And so when we discuss about monetary policy, we cannot discuss monetary policy in a vacuum without thinking at the same time what's happening at the fiscal level, and whether the ECB will need this extra instrument. That really depends on whatever happens at the fiscal level. But the distinction between monetary and fiscal policy are really blurred at this point.
That is really interesting. Thank you, Lucrezia. And it strikes me that very often Philip Lane, Christine Lagarde, other board members have gone out to explain how the different instruments actually work together and complement each other. That's very clearly part of the thinking. And as you mentioned, we have been promised some new instrument, or that it's been looked into. So we all wait with bated breath. But that's going to take some time before we get a new ECB instrument. For now, we have even better. Pierre-Olivier, it's your turn.
Well, thank you very much, Martin. Fascinating presentation. It's really a pleasure to be here. Let me quickly turn on my slides. Please let me know if you can see them so that I can proceed. Martin, do you see my slides? Very good. So unlike the previous three speakers who have been looking very closely at what's been happening with inflation and fiscal policy in the banking sector from an EU and Euro area perspective, I will take a little bit of a step back and look at things from the perspective of the international monetary system and what's been happening since the beginning of the Russian invasion of Ukraine on February 24th. And I want to start with basically making 3 points. I want to look at how the international monetary system has coped so far, especially from the perspective of emerging markets. Then I want to discuss briefly what the recent developments, and there's been a lot of discussions about the impact of sanctions, in particular financial sanctions, on possibly the role of the dollar going forward. And of course, that's a key question for the structure of the international monetary system. So I want to offer a few remarks on this and then conclude with implications for potential implications, both for the EU and also for the institution I now represent, the IMF. So let me start with emerging markets and the war spillover to emerging markets. And on the left here, on the graph on the left, what I'm plotting are capital flows from emerging market, the outflows from emerging markets since the onset of the war. And initially, there was a lot of worry that we were about to experience something very, very similar to what happened in March 2020 at the beginning of the COVID pandemic. You can see the red line is the gross capital outflows from emerging markets starting in March 2020. It was very abrupt, very, very large. And effectively it stopped when major economies, central bank, in particular the US, started putting together an expensive network of swap lines that sort of backstopped the financial system. And the black line here shows you what happened since the war. You see the two lines initially track each other. And so there was a lot of worry that we were about to experience a major a major dislocation in emerging market capital flows. But this stopped fairly quickly after 2 or 3 weeks. And it's only recently that it has started to resume downwards. Now, the other thing I want to point out is if you look at the composition of these outflows, it's quite interesting. Most of the outflows are actually capital outflows from 2 countries or regions, China and Taiwan. So a lot of the outflows are actually not coming from countries that are directly close trading partners of Russia, Ukraine, or a broad sell-off of emerging markets. Very, very concentrated. In fact, initially, there were capital inflows in countries like Brazil. So there was a lot of differentiation in terms of emerging market capital flows. And it is quite interesting that the way the markets interpreted what was going on is that there was a lot of uncertainty maybe going forward in terms of investments in China and Taiwan. Now, a second observation is in the middle graph. What we had initially in middle and third graph here on the right was the response of exchange rates. Initially, precisely because you had this huge differentiation between countries that were seeing capital flows out and countries that were seeing capital inflows, the average response of exchange rates were fairly muted. That's a black line on the right diagram, but with a lot of differentiation across countries. So Brazil saw its currency appreciate, and other countries that were maybe closer to Russia and Ukraine, like Hungary and Turkey or Poland, would see their currency depreciate. Now, more recently, in the last month or so, in the last 6 weeks or so, there's been a much more general downward adjustment in currencies vis-a-vis the US dollar for a lot of EM. So that's why you see a lot of the red bars on this diagram. There are very, very few countries that are still appreciated relative to February 23rd. So the bottom line here is in terms of what we've seen on the emerging market side, it's been relatively resilient. Lots of capital outflows initially, but a lot of differentiation, currencies adjusting downwards, which of course in many cases is a helpful development. I mean, it can be sometimes problematic for countries that have a lot of foreign currency debt, for instance, but that does not seem to be triggering a lot of hardship so far. So quite a bit of resilience here. And in a sense, I would say that, of course, things could change and that could be the next shoe to drop. We could wake up tomorrow morning and realize that there's a major sell-off in the emerging markets. But so far, this has not happened. And I think it's worth pointing out because, in the sea of bad news, this is sort of one of the bright spots. And this resiliency is in part attributable to the fact that many countries have sort of adopted monetary and fiscal framework that allowed them to absorb some of these shocks, letting their currency depreciate, managing their FX vulnerabilities ex ante, so they would be in a position where maybe this would be less damaging to let the currency adjust. Now, the second observation I want to make is about the importance of the dollar in the international monetary system. Now, this slide that you see here is just a recap of a thing that many people and everyone, of course, around the table, but many people already know, which is the absolute dominance of the dollar when you look at international financial markets, whether you look at issuance of international debt or loans, to the two panels on the left, whether you look at FX turnover, you look at the currency in which global payments are made, or whether you look at the composition of foreign exchange reserves. The blue bar, which represents the use of the dollar, is just the dominant currency here. And the same, of course, is true, as we well know, if we were looking at the trade side and the currency of invoicing. And this has been something that has been documented for many years, and sometimes to the surprise of commentators, and what could justify this absolute dominance. What is new here since the onset of the war is the fact that the US and other countries, including many European countries, but really coming at the initiative of the US, have started to use this dominance to impose financial sanctions, and of which, of course, the freezing of the reserves of the Central Bank of Russia is one one of the major developments, but also including the de-swifting of financial institutions, or some Russian banks losing their correspondent banking privilege. All of these sanctions, some of which had been already deployed in the past against some countries, but really not to that scale, and really not against a country of the size of Russia. And so this raises the question going forward of what is what is likely to happen to the role to the importance of the dollar and the structure of the international monetary system. And here this is this third slide that I'm showing you is illustrating the evolution of the composition of reserves over time. You can see in blue again, this is the dollar reserve holdings by major central banks around the world, and it represents about 60%. The important thing to realize is that the dollar or foreign exchange reserve holdings is really by far the largest component of the global financial safety net. I mean, if you think about the amount of resources that can be mobilized in short order to try for countries to try to help defend themselves or offset capital outflows or sudden stops, the overall global resources are on the order of $20 trillion. And 16 trillion of this 20 trillion is in the form of reserve accumulation. The fund, the IMF firepower is about $1 trillion, even after the last rounds of augmentation of its resources. So really, it's the disproportion. By far, the first line of defense here is in terms of reserve accumulation, and the majority of this is held in dollars. And so that raises the question of what will happen to these dollar reserves if somehow they can now be targeted and be unavailable. I mean, clearly, there are multiple reasons why countries are accumulating reserves. It's not just for prudential reasons. It's not just to try to prevent a private capital outflow or sudden stop. There could be also accumulation of reserves having to do with stabilizing their exchange rate or other motives, but that's an important component, and the way to interpret what's been happening is that certainly for some countries it will reduce the desirability of holding dollar reserves if these reserves are not available when countries really want to have them, or if they anticipate that they might not be available when they want to have access to them. Now, there were a lot of discussions in the immediate weeks following the imposition of the sanctions that somehow this would maybe indicate that there would be an immediate or imminent demise of the use of the dollar. But of course, the immediate answer to that is, well, it can't quite be the case, because there isn't really any alternative asset that could be holding the equivalent of this, 60% of this 16 trillion, so about something like $9 trillion in other currencies. So the immediate threat is probably fairly limited, but what it suggests is that it's the overall holding of reserves perhaps that is going to be less desirable going forward. If reserves are not really providing much insurance, then we might see countries deciding that they can do without them. Maybe they don't need to have such vast holdings after all. So the question is not so much should they move them into Swiss francs or into currencies that might be having regimes that are maybe more friendly to the reserve currency holders, but maybe more generally, maybe we don't need as much reserves. And then that brings up the question of what is going to be the overall size of the global financial safety net if we don't have that very important leg of reserve accumulation. Now, there are a number of reasons, and people, including myself, have written over the years of the fact that reserve accumulation is not necessarily an ideal form of insurance against shock. It's a self-insurance. It's a very costly one, because what you have here is effectively you have relatively poor and developing countries saving in the form of US treasuries that pay zero nominal and negative real returns. So it's certainly a very expensive proposition. But if we don't have this, then there's certainly also potentially less insurance in the system. And this, of course, takes place in the context of something that is going on, sort of a low frequency transformation here, of which that is sort of in the background, if you want, and has sort of just come to the surface very very sharply with the Russian invasion of Ukraine, and also in the context of how different blocks might self-organize here. And what I'm talking about here is of course the relative decline in the share of the US economy in global output. So this graph here is showing you the share of US output in total output. That's the red line, where it was above 20%, and it's on its way towards 15%. By 2026 or so, if according to the latest projections we have, and this is of course offset by the large increase you can see in the share of China in the global economy. That's the blue line, and more generally in other emerging markets. And so here, the tension that people who study the international monetary system have long noted is the fact that you have this absolute and organic dominance of the dollar in the present, but eventually it will have to change, because you can't have a global monetary system that is anchored on a country that represents, let's say, less than 10% of global output or 15% of global output. It just doesn't add up, and so we have to transition to a multilateral system. And there are two ways in which we could transition to a multilateral system. One form of the multilateral system would be the emergence of blocks. The emergence of blocks effectively makes the world smaller. There is a dollar block, and now within that dollar block, the US economy is a larger share of that dollar block, and it can anchor that dollar block and provide dollar reserves. And it could be a China block, and within that China block, then maybe the renminbi is providing the same role, and it could be maybe a third block. And then of course an important question is, one would expect that the EU and would be within the US bloc, but that's an open question. And the second option, if we're going to transition to a multilateral system, is to have a multilateral system, but to preserve the integrated economy, to prevent the fragmentation, or as Lucrezia mentioned, the balkanization. And that requires work and effort on our part. I mean, I think what we're seeing right now is the strength of the centrifugal forces that are being unleashed with the war, but are reflecting sort of an underlying tendency and underlying forces, an underlying drift, if you want, in between different economies. And that transition needs to be managed very, very carefully, because otherwise we could inadvertently fall into a very fragmented world. And I think that's the direction we're headed towards, unless we take forceful action. So I would conclude with a few observations on what it means for the IMF, or what it means for the European Union here, which, if you've noticed, I've talked about the US and China, and I've sort of left open where the EU would be. And I think that's going to be a key question going forward. So first, I think there is a need to focus on the common goods. I mean, there are a number of things that can only be addressed at the global level. Whether we think of, obviously, the first one we could have in mind is climate transition. There is no sense in which we could successfully negotiate climate transition if we have blocks that are sort of on different paths and taking decisions independently from one another. And so clearly engaging on climate transition is one way in which we have to be all at the table. There is the issue of debt and potentially debt crisis. I mean, an institution like the fund is clearly in the business of providing financial assistance to countries that have a balance of payment difficulties. We don't print money. The money we provide to countries in need is coming from other countries. It's coming from the resources that we are endowed with globally. And so clearly a world that is more fragmented also means that countries, as I've just described, have access to a smaller global financial safety net. And therefore it means that potentially debt crisis could be more severe or could be more frequent also. And so there is a need to think about the way in which we provide, we manage debt restructuring. This is an area where it's very difficult to make progress, for instance, and that's an area where we see also a lot of the confrontations between, say, Paris Club type countries and bilateral official creditors, whether it's China or other countries. It's very difficult to make progress, and it's absolutely needed. We've seen discussions around food security, energy security. Clearly, we're in a world that is more risky, and there's a need to manage and to increase resilience. There could be a new pandemic, there could be additional shocks, Even if we remain in an integrated world, there would be a need to rearrange or restructure the structure of global production in a way that increases resiliency for each country, and that's something that also needs to be coordinated. And finally, I would mention digitalization. The digital currencies, in the sense of have no geographic borders. They are both an opportunity, but they're also a tremendous risk in terms of financial stability or monetary stability. It again is in a sense is a common good, something that when we think about cross-border payments, something that would require coordination and cooperation on how to regulate and how to manage cross-border payments and digital cross-border payments between private entities and public entities. Now, final thoughts on the European Union. I would just say that this is causing a lot of challenges. Previous speakers have mentioned many of them on the fiscal side, on the monetary side. I would say that the prospect of common fiscal capacity, I think, is really critical in terms of how the EU will develop going forward, because this is the way in which the EU will also be, in a sense, providing one of the safe assets that is needed to undergird the international monetary and financial system. And its seat at the table will sort of be dependent on that. And so even though there are other reasons, you don't start issuing debt because you want to issue a safe asset, but there are other very good reasons in terms of common goods at the EU level, whether it's energy security, defense, whether it's pandemic preparedness and things like that, or common investment for wanting this. But they have this additional benefit. And then there is another issue, which is an issue of governance. There has to be the rise of emerging markets means they have to be represented adequately in international bodies. The symmetry between their economic power and their governance representation is a gap in terms of our overall governance, and that requires some soul searching on the part of European countries and advanced economies more generally, in terms of things like negotiations on quota representation in international organizations and things like that. I will stop here. Thank you.
Thank you so much. Can you hear me? I tried to unmute myself and then the screen changed because you removed your slides. Thank you so much. That was comprehensive and again a little bit pessimistic, I fear to say. I now have some excellent questions sent by several previous winners of the prize, and I'm very tempted to go in reverse order because especially the last one for Pierre-Olivier is very much into what you've already said, and in fact you've already answered some of it, so I think you can very quickly address a little elaboration. So allow me to go in reverse order, and I'll start with a question from Markus Brunnmeier for Pierre-Olivier. He asked two questions, really. The second one is about what to do about avoiding fragmentation. You just answered that at the end of your presentation. His first question was, will it, and if so, to what extent will the freezing of the Russian central bank accounts hurt the position of the US dollar? You did address that, but I wondered if I could ask you to talk a little bit more about the euro, given that it is a policy of the EU and Eurozone countries to increase the international role, the international use of the euro. So could you just elaborate a little bit on this international monetary system issue with respect to the euro specifically?
Of course, and thank you, Martin. I mean, I would make two quick comments on this. I mean, the first one is that whether the U.S. is being hurt by the freezing of the central bank of Russia assets. I mean, as I've discussed, it's in the short run certainly a little bit unclear. In the medium to long term, it certainly reduces the desirability of dollar assets. And so it causes what I've called a sort of a geopolitical version of the Triffin dilemma. I mean, you have this very powerful weapon in terms of being the dominant currency, and you can use it, but then using it, in fact, sort of undermines its value for the holders. But coming to the EU, there are two things. To the extent that there would be some alignment between the US and the EU on many of the if we're thinking about Russia, for instance, or we're thinking about many other scenarios, then it really, from the perspective of the holders, it really doesn't make much of a difference whether it would be a euro asset that you're holding or whether it's a dollar asset. There have been some discussions about the fact that some countries have diversified their reserves away from the US dollars to Australian dollars or Canadian dollars, but for all intents and purposes, these are all 100% aligned with what the US is doing. So it doesn't provide you a hedge against a geopolitical risk. If you want. There's a second observation about the EU and the increase of the role of the euro, and which I've mentioned is a desirable thing, but it's a double-edged sword. If you are offering a safe asset, it means you're selling safety. Selling safety means that when things are bad, and when things are bad globally, they are worse for you because you're a seller of insurance. You have to be willing to do that. The US is willing to do that. Japan in the 1980s, when they were contemplating maybe increasing the use of the yen as a reserve asset, they decided that they were not prepared to do that. My sense is that the ECB, in particular the EU, has sort of mixed views on whether they're really prepared to do that. And I think different countries in the euro area have different views about how willing they are to be the provider of that type of insurance. I mean, clearly you can think of within the euro area as Germany is providing that sort of insurance. We've seen sort of the flows of capital moving to Germany during the Eurozone sovereign debt crisis and the yields on the bonds collapsing relative to other euro area countries. And Lucrezia talked about that fragmentation. That also comes with a cost, an implicit cost for the German net foreign asset position, if you want. And countries sometimes are not willing to, not very excited about that.
Yeah, we have indeed seen that the challenges even doing that within the EU. The sort of measures you have in mind are, just to be clear, it's things like swap lines to non-EU countries, for example. It's that sort of instrument you're talking about, or the willingness to do that kind of help.
Effectively, I mean, you either have some sort of debt instruments that are non-contingent, and then it's not necessarily ideal in terms of providing insurance against global shocks, or you have to be ready to extend central bank liquidity, which of course has to be backstopped by a common capacity. And at the end of the day, I mean, it's the case for the US as well. I mean, the Federal Reserve can extend swap lines, but it's really because it's backstopped by fiscal resources. So it raises immediately this question of what is the fiscal backstop if you were to start expanding liquidity swap lines on a large scale to the rest of the world.
Very good. I will, with your permission, go in reverse order now with the other questions, but I'll just say that all of you will have thoughts on all of these questions. So if you feel like addressing something that's been said, please do so. You will know yourselves what you most want to contribute with. So let me ask Lucrezia a question from Veronica Guerrieri. And again, it's a question you in part covered to some extent in your remarks. She refers to a Project Syndicate column of yours where you suggested that fiscal policy, as you mentioned today as well, can help improve the trade-off between inflation and output. And she's asking specifically about energy bills and what one might have to do fiscally to help people and I suppose businesses with energy costs. You discussed that in a general way. So I'll kind of repurpose her question or sharpen her question a bit to asking you to be a little bit more specific. I mean, how should European countries design help for those now facing very high energy costs? I mean, there are political and economic considerations, I suppose, but what is your thinking around how to actually do it?
Yeah, this is a difficult question. I will get to that question, but so, I mean, there are, first of all, introduction. Okay, so the point I made is that in principle, fiscal policy can be more targeted than monetary policy, but of course the devil is in the details, how to do it. Then fiscal policy is also useful, but this is not Veronica's question because, that you have to make sure, because monetary and fiscal policy coordination is what is needed to avoid the segmentation that I was talking about and also Pierre-Olivier talked about. And the other question is what has to be national and to what extent has to be national and to what extent has to be federal. Okay, so that's the question of the common fiscal capacity. And then there is Veronica's question, okay, so at the national level, what can you do, okay? Okay, so frankly, countries are already doing all kinds of things, okay? They have used temporary reduction on energy taxes. Some countries have done that. This is clearly not very good because it can decrease the effect of sanctions, especially, the effect of sanctions on gas. So, I mean, from a just basic economic point of view, I mean, I'm not really an expert on these things, but it doesn't look like it makes a lot of sense. The other thing that has been done is flat transfers mostly to consumers. And here the question is whether this policy can be calibrated so as not to decrease the incentive to reduce energy consumption, okay? And so I think, again, the devil is in the details, but probably you can design this kind of policy in such a way that, there is not this effect, which would be counterproductive. And then the third type of questions is the cap on electricity price, which electricity price is very much linked to gas prices. Now, clearly, if the price, you set the price below the marginal cost, economists don't like that, right? Because that's inefficient. But of course, from the welfare point of view, this could actually be more beneficial to consumers. So it's not clear. Again, I mean, you could calibrate it in a way that this will have the redistributional effect that you think is appropriate. Okay, so I'm not a Taliban against this type of policies. Now, the other thing that you need to worry about is whether these policies are compatible with other energy policies that you want to put in place, like, for example, tariffs. And again, you have to think about the right mix because a tariff on gas has the effect of decreasing the volume and the price of Russian export, while the subsidies decrease the impact of this on consumption. So you have to. So, I mean, I'm really not a tax expert, but I think that, at the end, I mean, now I see that governments are doing on their own. So everybody is experimenting, different, European governments are experimenting with different mix of these policies. I mean, in a way, it would be to the extent to which tariffs and sanctions and these things are going to be common policies, it would be good that also this national policy would be made coherent. There would be some indication so that there would be a coherence of the national policies. But in principle, okay, to the extent that there is, that this policy, kind of go against these negative shocks on real income on some group of population, they should also limit the second round effect and make the life of our monetary policy easier, in principle.
Pierre-Olivier, does the IMF have a set of recommendations on how to help businesses and consumers with high energy costs and how not to, in particular?
Well, yes, we have thought about this, and we, I think, are in broad agreement with what Lucrezia described. I mean, we're in an energy crisis, and so there is a need for some compression of demand, so muting the price signals doesn't go in the right direction. There is a worry that some governments might be tempted to do that because it makes the inflation numbers look good, and so somehow there is a confusion between the fiscal policy and monetary policy, and I think it's a slippery slope to go from there to things like price controls and things like that, and so we certainly don't want to encourage that. There is a need to protect vulnerable households against elevated energy and food prices. So there are ways of doing this, and what we advocate is the use of sort of targeted measures that would offset the loss in terms of purchasing power, but without necessarily preventing the pass-through of high energy price to the consumers or the final users, so that there would be a demand compression. As a side note, estimates that we have on the elasticity of demand are that the elasticity of demand is much higher for the household sector than it is for the firm sector. So if you're going to want to achieve some compression of demand, if you think about the fact that you might want to reduce dependence on Russian oil and gas, for instance, it seems sort of backward looking to sort of try to do it by compressing the demand on the corporate side while insulating the household side entirely. There's more room for households compressing their demand if they are facing some increase in price, and you can try to compensate on through other measures. So I think that's quite in line with what Lucrezia was describing.
Thanks very much. I suppose politicians will say that what that high elasticity of demand looks like in practice is poor people switching off the heating, and that doesn't work politically. That will always be the problem. Vito, the question for you from Evi Papa. And again, it touches on, you already talked about the Stability and Growth Pact rules. So the question is, we have a debt overhang. I paraphrase in the interest of time because it's a bit long. We have a debt overhang after the fiscal stimulus that helped arrest the recession, the downturn in the COVID crisis. We now have higher energy costs that put extra strains on budgets, as we've heard from several of the others. And at the same time, the green transformation has been initiated, and supporting that transition while consolidating the fiscal budget could be another impossible task for many countries in Europe. How can we face this challenge? So how do you think about Stability and Growth Pact rules, or fiscal rules more generally, in the context of the green transition? You are still muted.
Sorry. Yeah, my first remark will be to recall that even the leader of the CSU Bavaria, Mr. Sodel, said that the greening requirements in terms of public investment would be contradictory to the sort of debt break that Germany has, and then exported to the EU in a milder version. Yes. There is a tension or even a contradiction there, and that's one of the reasons, but that's not even the decisive reason, as I mentioned, that we need a meaningful reform of the fiscal rules in the EU. Well, many academics and even institutions like the Independent European Fiscal Council have recommended over the years going to an expenditure rule. The expenditure rule, to be taken seriously, means that there is a long-term debt ratio target, and that the progression of expenditures over time is calibrated, taking that into account for a long-term convergence to that target. The problem is that we have in the treaty 60%. This 60% came about how? And I recall better than others how they emerged. Well, they were imposed in a way by Germany, but there was an economic sort of rationale. There were two. The first one was not an economic rationale, was just that it happened to be the average of the debt ratios of the 6 countries that were more sizable in the EU, and they had 60% debt ratio at the time of the preparation of the Maastricht Treaty. The second reason was more economic, and was the following exercise. Let's assume the worst case scenario, that in terms of the treaty, all countries would have permanently a 3% deficit. That was not the idea. The idea was that it was a absolute upper limit, the 3%. But let's assume that they would have 3% forever deficit. At the time, good times, the idea was that growth in real terms would be around 3%, and that taking a target for inflation of 2%, that would be 5% nominal growth. If you make the calculations, you can demonstrate that in the very long term, 3/5 converges to 60%, the debt ratio. And that was, say, the economic rationale. If we repeat the exercise now, we won't have 5% nominal growth. What we have in the EU is, say, the 2% inflation long-term target, and then we have as potential growth rate 1.25, or even a little less, meaning that that ratio then would converge to 92%. So let's round it up to 90. That was my rationale for advocating the 90%. And if we do that, then and apply an expenditure rule, then indeed we can accommodate with the proper measures on the fiscal policy in general, we can accommodate the two targets, meaning that indeed the expenditure rule could target such a debt ratio and could accommodate, depending on numbers country by country, of course, could accommodate the requirements, in particular in what regards greening investments that have to have a sizable public component in there, although the bulk of investments will have to be done by the private sector, of course, and private firms, but they have to be helped. Otherwise, as I said before, many of those investments will not be sufficiently profitable for them to embark into implementing them. So the state has to provide infrastructures and other supports to make that then feasible. So that would be then there are there are ideas that on top of this, or perhaps without changing the debt target, one could have a certain forbearance for greening public investments and introduced a certain limit of exclusion of those greening investments from any fiscal rule. That's an idea, which of course breaks the rule to be rigorous, but nevertheless can be accommodated if it is within reasonable limits in percentage of GDP. It can be accommodated and make the greening public investments more implementable.
Thank you very much, Vitor. It does sound like, on the whole, a more sensible, as you describe it, fiscal rule framework can actually leave a lot of room for the investments we need in any case. Last but not least, José Manuel, there's a question for you from Ralph Coyen, but you may also want to comment on some of the other things that have been said in the last couple of interventions. But Ralph recalls the doom loop from the sovereign debt crisis between stability in the financial sector and the stability of sovereigns. And he points out that not only banks, but insurance companies can also have concentrated holdings of sovereign debt. And the question is simply, how resilient is the current financial system? Is there a potential that the doom loop returns as we get higher interest rates and probably higher sovereign credit risk?
Yeah, thank you. I mean, I think this is a very valid point. I can link it to some of the initial comments made by Vito, and particularly by Lucrezia, which I think already pointed as this as a potential clear and present danger, I would say, going forward, which is the risk of financial fragmentation within the European Union. If, as we see the situation evolve and we see interest rates in the different countries evolving in different directions, particularly spreads increasing at the national level, ideally one can think that in theory that could affect only sovereign exposures and not the overall economy of that country. But we know as a matter of fact that that's very unlikely, and that as interest rates rise will affect across the board all borrowers of a given country. So that's a concern for financial stability and for financial fragmentation that we need to keep very much in mind. Now, as we go further and we think more micro in terms of the impact for banks and insurance companies, and I'll talk really about banks, I think that the situation in that sense is probably better than in 2010, 2012, because first, the overall size of sovereign portfolios on banks' balance sheets has been declining since 2010 across the European Union, not for every banks in every country. Some banks in some countries still remain similar levels to what they had before, but on average they have declined. Then the second aspect is also that the degree of domestic concentration of those sovereign portfolios by banks has also declined. So just to give you some numbers, in 2013, at the peak of the sovereign crisis, there was a 68% of the sovereign portfolios of EU banks were domestic. So it was the ratio of domestic sovereigns in total sovereigns. And at the end of last year, it was 52%. And this was even after an increase of about 5 percentage points due to COVID because of the increase in the debt ratios that COVID arise. So in that sense, the situation of the banks is better. But at the same time, I'd like to finish with a significant warning that we haven't talked about, which is that we do not have a full banking union. And in this context, the progress that was made starting in 2013 had as part of that delivery promise was a banking union. And that banking union is still not complete. I know that the president of the Eurogroup is working very hard to come forward with an action plan for next month, I think, for the Eurogroup. I hope he succeeds, but let's be honest, that's a real challenge. And the same way that I said that the degree of domestic holdings of sovereign bonds has decreased in terms of percentage of the total holdings of sovereign portfolios, it's also true that the degree of cross-border banking in the European Union has declined from the previous global financial crisis, and that has not increased. And as a result of that, the degree of what I would call private risk sharing, the amount of risk sharing that's been done by the financial sector across the European Union, that has not improved since the financial crisis. On the opposite, it has declined, and that's a vulnerability. So I think that, to me, first and foremost, we need to avoid the financial fragmentation that will come with the increase in the sovereign, in the different interest rates, and then we can hope that also that will not trigger down into a new loop of banks and sovereigns, but we cannot be sure of that.
Thank you very much. Unfortunately, our time is up. We could continue for a long time because it's been a fantastic discussion. But the last point you made, Jose Manuel, about waiting for banking union sort of allows me to say more generally, by way of conclusion, that sometimes facing new challenges, we would actually have been in a better position if we hadn't left unfinished business from previous ones. So let's hope that we finally get around to some of those, both banking union, reforming the fiscal rules, and so on. We could have started from a better place. I think the same is true of energy union, and there was talk of this, of course, in 2014 and before. Anyway, that is how Europe progresses as well, by finally picking up unfinished business when there's no other choice. So may it be this way this time as well. I will now hand it over to Guillermo de la Dehesa, who has many merits to his name, but I think is finishing our day in his capacity as chair of the OBCE, the European Central Bank Observatory. So I think by some magic, we will probably be taken down from the screen as he takes the stage in the auditorium. I will let the technical people deal with that. I will just thank all of you on the panel, everyone for watching both remotely and in person. Thanks everyone. This is all from us.
Yeah. Thank you. Bye.
Thank you, Martin.
Thank you.
Bye.
And thank you, Martin.
Just a few closing remarks. Ladies and gentlemen, good afternoon in Europe, good morning in the US. I will be very brief. My name is Guillermo de la Dehesa. I'm the chairman of the Observatory of the European Central Bank, the organizers in this conference together with Ramón Areces Foundation and with the support of CEPR. I was chairman of the CEPR 10 years, but I am not honorary chairman. To celebrate an important milestone in the history of the Germán Bernàcer Prize, we have gathered in this conference a good number of prize winners and members of the selection committee over the years, all among the best economists in Europe, to discuss on the macroeconomic policies for Europe and the current exceptional juncture. We are very grateful to all of them. With this great conference, we close in the 20th edition of the prize, and we are also opening the next edition for the 21st edition. It is my pleasure to invite our audience to submit nominations for the 21st edition of the Germán Bernàcer Prize by June 26, 2022. The procedure is very easy. You can consult the rules over the website of the prize, and I would like to take this opportunity to express our gratitude to all that have contributed to the creation of this prize, and it is already consolidated over 20 years. This prize has become the main European prize for economists in the fields of macroeconomics and finance, thanks to the contribution of many people. Many thanks in particular to all the members of the selection committee over the years for this crucial contribution selecting the prize winners. A special thanks to the members of the Executive Board and Vice President of the ECB, who have chaired the selection committee over the history of the prize, and also to the governors of the Banco de España for their continued support since the very beginning, since the creation of the prize 20 years ago. Finally, to our big audience, many thanks for having joined us today. And please don't forget to send up your nominations for the 21st edition of the German Bernàcer Prize by the 26th of June. Thank you very much.